Now I wanted to talk about another news feed I saw earlier this week, and it's about Dave Ramsey again. And I'm not, by the way, picking on Dave Ramsey. I think generally speaking, his advice is very good. I'm all about reducing your debt, saving money, and all those kinds of things. But this headline really, again, caught my attention, like the other one that I had on the program here a week or two ago. And here's the headline from Dave Ramsey: Renting is not a waste of money. Mortgages, student loans, and 5 other things to actually avoid. Now, the "oh really" part is my snarky add to that headline, and this was in the Go Banking Rates on August 28th. And here's the premise of the article from Dave Ramsey uh, in regard to renting not being a waste of money. He basically suggested that you should continue to rent until you're financially able to buy a home. And that's because housing is an essential expense. Well, of course it is. Everyone needs housing. And so in that regard, it is an essential expense. And he further suggested that you should pay off all your debts and save up a large amount of money for a down payment first before you buy a home. But that struck me as interesting because if you recall, not too long ago, a few weeks ago on our program, I had mentioned that Go Bank Rates had another article that pointed out the average household will take more than 15 years to save up for a 10 to 20% down payment. And they featured 6 different cities in California where that would be the case. And that's a pretty sober statistic in relation to what Mr. Ramsey's suggesting, that you should save up a lot of money for a down payment before you buy a home. It's a challenge. In fact, I would argue that probably the biggest obstacle I run into, and most anybody that does what I do run into with a prospective home buyer, is lack of down payment. And the article further went on to say, when you buy a home, you should pay cash if possible, or take out a very small 15-year loan. Again, is that reality? I'm not so sure. The idea is it's going to help you avoid unaffordable mortgage payments and high interest charges. Of course it would. A 15-year loan is going to save you money on high interest charges because it's a shorter term, and the interest rate on a 15-year loan generally tends to be higher or to be lower. However, in terms of mortgage payment, the payments are higher. And of course, as I pointed out, pay cash, that's not realistic for most home buyers, particularly not a first-time home buyer. And so in that regard, it's just an interesting suggestion by Mr. Ramsey that you should wait to buy a home until you're able to pay cash or provide a very large down payment and then get a 15-year loan that's got, on average, a 33% higher monthly payment than a 30-year fixed. I'm not sure that's a realistic goal, to wait until you can save up a substantial amount of money or actually save up enough to pay cash for the home. The other thing he mentioned was avoid ARM loans due to the higher future interest rates. Well, true to some degree, but what that suggestion, I think, misses is that most ARM loans today are what we call hybrids or fixed ARMs. You're going to have an interest rate and a monthly payment that's going to be fixed on average from 5 to 10 years. So the most popular ones are 5-year ARMs, 7-year ARMs, 10-year ARMs. That means the interest rate and the payment are going to be fixed for that fixed period of time, 5, 7, or 10 years. And if you remember, again, on the program here not long ago, I had mentioned program length. The average mortgage, certainly in California, has a life of less than 10 years. So an ARM loan is not one to avoid necessarily. What you want to do is look at an ARM loan if you're pretty certain you're not going to have that loan or maybe that home beyond the fixed period of the ARM loan. And in fact, the most popular ARM loan that's made today, I would argue, is the 7-year ARM. That's one where the interest rate and the payment are fixed for 7 years. And so most borrowers who get that type of loan are generally thinking they're likely not going to have that loan past that 7-year fixed period, either because they already know they're going to be moving, they're not going to keep the home that long, or they're betting on the fact, which right now I think this is a good bet, that interest rates over that 7-year period likely will go down. And when that happens, they can then look to refinance into either another fixed ARM or maybe more likely a fixed rate loan like a 30-year fixed, or maybe a 25 or 20-year fixed. So that's really why an ARM loan is generally not such a bad idea in the right circumstance for the right kind of borrower who understand how it works and who's made some decisions about how long they think they're going to keep the loan or the house, and try to establish a situation where they're not going to keep that loan past the fixed rate period. The other thing that the article pointed out, which I thought was interesting, is he said avoid FHA loans because they have lifetime mortgage insurance. Well, as of course I pointed out on our program here not long ago, FHA, I think, is probably the greatest loan program the country's ever created, the U.S. has ever created. And yes, there is mortgage insurance on it, but I've pointed out in the past that there's many benefits that are associated with that mortgage insurance in terms of helping first-time home buyers get financing, which, even though that's not the case that you have to be a first-time home buyer to get an FHA loan. I've pointed that out many times. Plus the fact that he's not totally accurate about they have lifetime mortgage insurance. If you put 10% down or more on an FHA loan, the mortgage insurance does drop off after 11 years. So from that perspective, I would not agree that you should avoid an FHA loan. And in fact, if you're looking to buy your first home, or if you have low to moderate income and maybe you're a little bit more credit score challenged, FHA, in fact, is a great option, and I think actually your best option. So from that perspective, I would disagree with Dave Ramsey about avoiding an FHA loan. And then the other thing about the article overall that I found interesting was that, as many of you may know, rents are at an all-time high. I mean, the median rent in California is nearly $3,000 a month. But interesting, if you're paying $3,000 a month rent, even at current interest rates, you can get a $500,000 loan and have a principal and interest payment that's going to be right in that level of $3,000 a month. And of course, you're going to have taxes and insurance added to that. But the point is, rents are at an all-time high. Rates are high, but given that's the case, it's really something you should look at to determine what kind of loan amount you can get, what kind of price level can you purchase at compared to where today's rents are, to determine if it makes sense to keep on renting, whereas you could be looking to purchase and then at least have the opportunity, not the assurance, but the opportunity to have that asset, that home, increase in value and start to build equity. So what you want to do as a prospective home buyer who's been renting, don't necessarily go with this advice from Ramsey to keep renting until you've saved a tremendous down payment, because it could take you years and years and years. But take a look at a rent versus buy analysis, and we can help with that on our website. There is a page with calculators, and we have a really good calculator that provides you the tax benefits of buying a home. So if you're a renter, and if you're paying substantially high rent, $3,000, $3,500, $4,000 a month, you're paying so much rent, you could actually be looking to buy a home instead. Go to our website, check out the tax benefits of buying a home calculator, and crunch those numbers, and it can help you decide if paying that rent is really the wise thing to do going forward, or if you really should reconsider and start looking at buying a home. So again, I'm not necessarily disagreeing with Dave Ramsey overall and with his advice about paying off debt, saving money, and those kinds of things. But I think in regard to this particular article, not sure I totally agree with some of the things he's suggesting, and I thought it would be good to share that with you. Thank you, everyone. Thanks for listening. Thanks for watching. Stay tuned next week for another edition of Mortgage Minute. In the meantime, I'm Art Alvarez at MortgageWorks, where we do have the answers, and they're on the house. Take care.